All right, welcome everybody. Good evening. We'll go ahead and put the chat up so you can drop a comment in there when you log on. And as we always do, we'll wait just a couple of minutes to get started here, wait for everybody to jump on, wait for us to go live on all the different platforms, and then we will get into it. But those of you just jumping on, feel free to drop a comment in there. There we go. Hello, Oscar. All right, Sonia, Juan, hello, everyone. Good evening, good evening. Geneva, good evening. Happy Wednesday, Jerry. Happy Wednesday, everyone. Sonia says the rain in the Bay Area stopped for like 20 minutes. I just heard some big thunder out here in Miami outside of my window.
Yeah, you're like 1 second behind me. I just heard that.
Yeah, it's going down out there.
Oh, wow. That's what that was, huh?
Yeah, that was crazy. Taryn said it snowed there today. Be grateful.
Yeah, I guess it could be snow instead of just some rain at 78 degrees.
Yeah. I love it, though. Everybody tuning in from all around the country. Beautiful thing. Okay, looks like we're live on all the platforms, so we can go ahead and get it started here. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and today's training is going to be about properly pricing your loans. And we're really going to focus on setting up your loans here properly from the start, some of these new trainings that we're doing here. So I'm going to just go ahead and kick it right over to Jose. He has a presentation he's going to pull up to talk about actually properly pricing and setting up your loans. So go ahead there, Jose.
Right. Good evening, everybody. For some of you, could be good afternoon still, right? For our Cali people. Maybe we even have some Hawaii people out there that are tuning in. But this is probably one of the most important situations you can face in the whole genesis of the loan officer, of getting the deal, of making money, of being successful, of having sustainability. I mean, this is everything because it involves all of our training, and our training goes really deep on structuring all these loans. Every quote that you're going to be sending out there, basically every pricing that you do is going to be like a mini structure, every single one, a little mini scenario that you're structuring. And if you're successful, if you're in tune with what is needed and provide the viable and relevant solutions, it's only to follow that you will be closing a lot of loans. I mean, because you're going to be doing the job that needs to be done in the manner that needs to be done, providing value, adding value. We're all about adding value to the transaction here as loan consultants at the Mortgage Calculator. You all know that we all like to train and talk about our intertwining thread is always having a little bit higher level of professionalism, always trying to wear our consultant hat, not a salesperson hat. So even though this is a sales meeting, quote unquote, right? But this is here, we're talking definitely one step above what we're going to get into now and the considerations we're going to make. Because if you do it successfully, you're going to be closing deals. If you don't do it successfully, you're going to be having issues, right? So customer service is key, right? We always have to consider that every loan that we end up doing as a loan originator is like a mini employment contract, right? It starts with the lead, then it goes to the call, which we're going to get into in a minute. Then you build the trust, the rapport. Then they accept your quote. Loan starts getting processed. Everything goes well, and you close the deal, right? But there's a lot to go in between to go from one end of that spectrum to the other, right? You know that there's a lot of competition out there. The borrower pool is going to expect that whatever happens quickly. They don't want a long drawn out process for issues that are non-existent, that are not caused by their particular scenario, but that are instead created by other variables going on here. Could be lack of knowledge of the MLO, could be, something is different with the credit than was actually represented. Whatever can happen in a deal. But we all know what the borrower expects, whether their expectations may be grounded in reality or not is another story, which obviously as a loan develops, we'll see where that stands. But we know what their expectations are. And until you have any other additional data, to state otherwise, you have to assume that that is what it is, full speed ahead to provide the quote, right? But there's a lot also that happens between the lead and the quote that's going to determine if you're going to if you're going to rise above all other MLOs. The cream rises to the top. So, real important, what you're talking about. That's why we stress our knowledge center. We stress, immersing yourself in the guidelines of the product type that you're trying to offer. Obviously, we like you to know all the product type guidelines. If it's an agency loan, then obviously it's going to be the Fannie Mae selling guide, the Freddie Mac selling guide, the FHA handbook, USDA, VA. Those are homogeneous guidelines that are subject to overlays by the individual investors, right? But they're pretty homogeneous in that respect. But when we get into the non-QM situation, for example, not every bank statement loan is created alike. Found that out a couple of times in the last week or so on a couple of deals we have going there. All those bank statement options have different requirements. Now, obviously, you don't find out a lot of these things until you go deeper into the loan. But some of the things that you can ask up front, and some of the research that you do will determine how quickly you deal with those situations to keep the momentum of the loan positive and not to make it seem that you don't know what you're doing. Hey, if they represent something and it changes different than what's available in the guidelines, that's different if it changed. But don't you make a mistake and offer something and they've already stated certain information and then what you're offering doesn't even match what they've already represented, then that's where we have issues. So again, you want to make sure that we have an accurate borrower and scenario, that we are considering all of those options, right? And how is it that we would end up getting there is that, we definitely need to request, when we get that call, right? That's usually, like they say, you only get one chance to make a first impression. And when you're going to get that call, you're going to have to make sure that you get as much detail as possible. This is also an opportunity to build rapport with the borrower. You don't just want to go in and out. One thing is to be on the auto dialer, but when somebody answers, it's go time, right? That's when you really have to be aware of what's going on, listen a lot, don't just try to talk over the borrower and not let them explain when you've asked them something because you have a predestined option already in your mind that you wanted to give out without even taking into consideration what's actually going on here, because you have, whatever, this is what you want to sell that day. And that's just not going to happen when you have all of this competition for value added transactions, right? We're not like cramming anything down anybody's throat and hoping it sticks. That's not the way it works here at the mortgage calculator. So, no assumptions on products, right? You have to be a consultant to be able to offer all the product options that we have that may be applicable to that borrower. All of these already have to be in your mind as you're having that call with the borrower to be able to engage the borrower during that call with knowledgeable, empower the borrower with knowledge, information, so that they start asking you more questions on the, all this interesting knowledge that you're throwing upon them, redundancy intended. And then that's when you click, and now they're reaching out, and now, barriers are down, and now you can actually get viable information to provide a relevant quote to the borrower. But again, you got to obtain as much as you can. You were talking credit scores, trade lines, credit events. Remember, it's not just about the score. Once they tell you the score, if it's high, you can, things like, hey, yeah, I mean, with the 740, I'm sure there's no collections or charge-offs, right? But if you see it's a 630, you may want to say, well, 630, okay, can you tell me why it's a 630? Are there any issues with collections, charge-offs, any overextended accounts, recently opened accounts, just so you can have an idea of what you're dealing with when you're putting together that quote. You don't have a credit report yet. You don't have to rush to the credit report because you can get a lot of information just from the call. Mind you, we're not talking rates yet. We're trying to get there. If you recall the training we had the other day on the sales call, okay, employ, all of that information gathering and empathy techniques, I guess I will call them, to get as much of that relevant information as possible. You know what you need, right? For non-QM especially, we're going to be looking at those credit events, stuff like foreclosure, short sales, deed in lieu for housing, BKs, late pays on current housing for the last 2 years and for the last 12 months, collections, charge-offs, all the things you see there. Critical, especially for DSCRs. You definitely would want to find out, housing history and investor experience. So a lot of things to consider here. This is the part that is going to allow you to shine, to not be an application taker. This is what's going to allow you to convert the lead, right? To convert the deal. You all ask about, and I'm going to relate this now to, leads and all that kind of, you all ask about how good are the leads that we offer. Well, they get to you within 2 or 3 seconds of the consumer clicking, opting in, and reaching out to you, right? And then if you reply quickly within 1 minute, it's a much higher conversion rate. And then if you, on top of all of that good stuff going on, provide relevant information, you listen, provided solutions, I can't stress enough to, let them, speak when you ask them a question, right? And I think that normally, if you hit the target with what they need, I think usually we're going to get those deals, especially if we're talking about on our specialty products like the DSCR, where we have so many options, from the no experience first time home buyer investor to the super experience with a beautiful housing history and all that, rates super low. So all of that is going to impact the accuracy of what you're going to be able to provide, which in the end is going to impact how well it is received by the consumer, right? They're doing their largest financial transaction that they're probably going to do in their whole life. And if you do a good job, you'll get to repeat that with them 2 or 3 more times or more, depending how sustainable you stay in the business. I've been 27 years in the business, so, I can tell you that it does work. Because, again, this is the key part of this training right here. This is why we labeled it properly pricing your loan, because in the end, no matter how well everything goes, no matter how well you listen, how well you spoke, all of that, if you do not execute on the plan, it could be over for you. You may not be able to recover. You may go off that cliff, smash yourself down on the rocks, it'll be terrible. But what are key issues that I find? And I'm going to tell you where this can affect you, because if you make this mistake and you come to a disclosure meeting and we're reviewing the compliance of your pricing, and all of a sudden here we are with the customer expecting a certain rate, you know, they may have already told you, yeah, that's right, Jose, I want that 7% rate. I don't mind paying 4.5 points. Beautiful. That's great. I got the money at that rate. Sheesh, I'll pay you 7 points. So you're happy, feeling good that you've done a great service to the borrower. But then, we come to disclose, and then if it's an agency file, we're going to run the Maven test to see if we're going to get 1 or 2 bona fide points, to see if we can even accept all of those buy down fees. At which point, if it fails, we have to restructure. If it's a non-QM loan, we're going to do the 5% points and fees test. I mean, we can run a similar Maven test as well, but I always like to do a rule of thumb calculations for that, which I'll show you in the slide at the end here that I have, to see, because we cannot go above 5% on any non-QM loan type, regardless DSCR, bank statement, P&L, business purpose, LLC, whatever. That's it. We do not go over total points and fees, including all lender fees, 5%. So, I mean, that's so important that you understand that, because if you make a mistake and you got to go back to the customer and explain to them what's going on, they may not take too well to the explanation. At that point, it's an uphill battle, right? Because what's going to happen is that if your cost is not in compliance, we're going to have to either reduce it, or if it can't be reduced for whatever reason, like if you have to go to a higher rate, they don't qualify, or whatever may be the situation, then it may result in a tolerance cure, which is not a good thing to have on a loan. All of these upheavals can have, a negative impact on how the customer experience, again, going back to customer service is key. The customer experience throughout the whole process, it has to be smooth, stress-free. You're the consultant, concierge service, white glove service. I mean, these are sophisticated people a lot of times, primary investors, whatever they may be. They value their time, and they don't want it to be wasted, and they don't want to feel like there's any bait and switch going on or anything like that could totally kill your deal. Right. So it's so important, again, that we, after seeing all the info and everything, we make sure that everything is applicable to whatever guidelines that we are using, whether it's agency or whether it's non-QM, and ensure that what you're offering exists, right? Not just looking at stuff like, the obvious credit, trade lines, housing, but like less obvious things where people make mistakes, like sending out a prime DSCR quote for a primary, for example. Yeah, the customer's going to love that all day long. And then when you go disclose it, we're not going to be able to disclose it. You may not be able to recover from that deal, from that mistake. Making sure, again, that the income type is the correct one for whatever pricing scenario you're selecting. Because sometimes, just make sure, if in doubt, there could be mistakes in the database of the pricing engines. If it looks too good to be true, you may want to verify it. You may want to check right there, click a minute in the guidelines, click on the matrix for your pricing and confirm, and if that doesn't make sense, there's ways that we can quality control that data, and in a short amount of time, confirm for you whatever is the correct information, so that you don't squander that opportunity by making a mistake. So this is the part here. This page is the one that is going to differentiate you from the masses, from the application takers, going to add value, is going to allow you to get, earn what you deserve to earn, fair to everybody, but since you're adding so much value to the transaction, everybody's happy because you've probably offered options to the borrower that nobody else has offered. That's key because, again, we're talking about providing multiple options for all income and LTV scenarios. This is where we shine, right? Since we have so many options. Again, I talked earlier about not assuming because, when you assume, what happens there, right? Everybody's heard that one. So then, the quoting system is so efficient that once you have it set up, it's so easy to duplicate all of the quote and get all of these different scenarios. In 10 minutes you could probably throw out 15 scenarios, 10, 15 scenarios, 1, 3, multiple year prepays. Now we haven't reviewed documents, so we don't know if the borrower's really DSCR, right? They could be full doc, bank statement, P&L if they're self-employed, because remember, we asked thorough questions during the interview. We have our mind already going with all of the options we're offering. We're all really happy that we have so many good, well-priced options. So we're offering, our self-employed borrower. Unless they tell you, I haven't filed a tax return in 4 years and I'm not going to file one for this loan, then you would offer a full doc tax return option, a bank statement, and P&L. For investment, again, full doc, bank statement, P&L, and DSCR. Remember, non-QMs, LLCs, right? Different LTVs, because sometimes at a lower LTV, the pricing is so much better that it makes more sense, because then you get deep into analyzing the benefits, right? Now we go into amortization tables, right? Because let's say at an 85%, it's a 9.5% rate, right? And at an 80, it could be a 7.99% rate. So not only do you have a difference in the overall payment, but now you're paying less interest and more principal within that payment. So if you really want to split hairs here and add value and give them considerations other people may have not, remember, you're probably competing against a lot of application takers out there. So you want to make sure that you have the best foot forward. So you're going to show them, if it has to be that amortization, it's real easy to get an amortization for a payment at different interest rates. And then you're going to show them the cost benefit analysis of that whole scenario. This is where, you're just recapping all the benefits so that the customer can make a solid, educated decision. And again, we're talking, conventional non-QM options as well in all of these situations, right? So now it all culminates with the final consultation, right? I was building it up. It's like, it's like the pyramid, right? Remember, in the end, we're not looking at recommending the option that makes the most money for us or the easiest one for us. Hey, I would love doing a DSCR loan versus doing a full doc loan with a borrower that has 10 properties and 5 LLCs, which I've had to do those before. But if it's the lowest cost option and the one the customer requests, if I don't do that option and they qualify for it, I'm in jeopardy of some negative actions from the regulators. So always have to recommend the lowest cost option. Don't overlook that option. Let them tell you they don't want it, if that happens to be the case, right? We're emphasizing all of the value that we've added to the transaction, all the different twists that we put to the different options that we offered, because a lot of times you don't assume and they see value in something that may not make sense to somebody else. So that may come from listening. And again, we're talking, this is probably when we're talking about that large financial transaction, if they don't trust you and think that you're actually being sincere with your approach and with everything you do, you're not going to get the deal. That trust and sincerity will keep you from getting shopped and will keep you from thinking that you have to be like a discounter to get loans. We're adding value and we have a low margin already. So there's no need to base it on, charging 50 cents less than somebody else. And, again, make sure that everything is viable and relevant, because if your quote is off trajectory, in the end, you could be almost right there and it could just blow right up in your face and then you have nothing. Or you could have a situation where you have a lot of deals, sustainable, you'll be 25 years in the business as well, right? So now I'm going to give you here an example here of what constitutes an accurate quote that you can provide and what doesn't. Now, this here would be one, usually a 15% down DSCR purchase. This is a good one, right? For a 1-unit property. But this is one that's prone to going out too expensively. So I went ahead and I analyzed, I saved pretty much all the applicable rates that were available, even though some of these I know are not acceptable. So I did an analysis here, and basically at 9.375% interest rate, and I'll show you in a minute I'll explain how we do that in a minute. And by the way, for when there is a training in the Knowledge Center on points and fees compliance, a nice video I put up there, so everyone please go there, check it out in the loan process start to finish. But right here we're looking at 9.375% rate, which is a rate a customer would probably pick, right? It doesn't look that expensive. But due to the fact that this is $170,000 loan, keeping in mind, we're talking about a percentage of the whole, right? The 5%. So as the whole gets smaller, the fixed costs like underwriting and processing become a larger percentage of the whole. So that's why I purposely picked here a $200,000 purchase with a $170,000 loan amount that represents a typical DSCR transaction in Middle America, right? We get a lot of these, and this is why it's so important that we analyze this before we send out the quote. It's real easy. I'll show you how to do a rule of thumb. You don't have to worry about setting up any Maven tests in Encompass. You do that when we're going to disclose the file, but to send the quotes out, we can come probably within 0.1% of the what the Maven test is going to give you. So at 9.375, our cost is 5.35%. That's 5.35 points. We are 0.35 points over. So if the customer accepted anything low at 9.375 and lower, we would be off. But that's not the only one that's off. I'm going to show you another in a minute. But right there, so you're going to get, and you're going to add up underwriting, processing, originating, loan discount, which is the buy down, and the MERS fees. Subtract that from the loan amount to get an adjusted loan amount, and then you're going to divide those total fees by the adjusted loan amount, and that's how I arrived at 5.35%. Took me about a minute to do the calculations, more or less, and then it's a lot less time to do the second and third calculations because I already have my base fees set up. The only thing that's changing is the buy down fee. And then, wouldn't you know it, that at 9.499, which is another rate that a customer would probably pick. It makes sense. Doesn't really cost that much, $4,208. But even that rate is at 5.08%. So that one's on the borderline where when we do the Maven test, maybe it comes in or not. But even then, on the quote, that's probably the lowest one that I would send out. I wouldn't send out the other ones, because if you entice the customer to select them, and then at the end you tell them, I can't give it to you, they're not gonna understand the reason. I mean, a lot of new MLOs don't understand the reason. How would you expect a borrower to understand the reason, right? I mean, we're the licensee. We're held above by the regulators and the powers that be. That's why we have a license, right? The borrowers are not.
So to be clear there, Jose, that quote is invalid that you're looking at there. We can't have that go out without adjusting it.
Correct. I mean, I only put it on there now for illustrative purposes, just so that I could, dissect it and show what could happen. But yes, absolutely.
And they're all real numbers. They're all real quotes. They're all real rates and programs that we have. But unfortunately, no matter how much the borrower or us want to do the 9375, the 925, we just can't offer it just because of the compliance rules. So, what are the two that we can send there, Jose?
Well, the
two?
the ones that we obviously can deal with are the bottom two. And then 9.499, we could probably deal with it because it's within a tolerance level that we could figure it out. But the other ones could only occur through some other processes, but not something that you would be sending out on a quote. You got to send compliant quotes as accurate to stay within tolerances, like with the 9.499, send it out. It's a good option. It's 0.08. And then even if it's 0.1, you're that close that we can figure it out. But the other ones, no. I mean, I've seen them where they're, like if we were to do 8.99, which is a good one. I've seen it selected a few times already. It would be like over 6%, 6 point something percent for this loan amount because it's $170,000 loan. However, if this loan was $500,000, then this would not be an issue. They could probably take it all the way to the 8.99 and do the deal because the proportionate amount of the fixed fees is a lot smaller, right? It's going to be like 1.5% more or less between all the other stuff, and then you can do up to 3.5% buy down and still be within tolerance. It's just because it's a bigger base that you're dealing with.
So all these are valid, but it's our job to know what at the end could become invalid. So you got to be very careful here, guys. That's a good example there, Jose. So edit that, send the bottom two, or I guess three, you said, right?
Yeah. Send the bottom three, give a solid explanation. You don't got to get into points and fees of the borrower on the explanation, but just a nice explanation. And then that spurs, additional questions and hopefully seal the deal. That's where, all the different variations of the quotes come into play as well. That's what's going to land you the deal. What's not going to land you the deal is if they agree to 8.999 and then you come back to them when you show up to disclosure and I tell you, no, I'm sorry, I can't do that. You want to go back to the borrower? Because that's what I'm going to ask them. If it's such a big difference, if we got time still that it's not expired, I'm going to tell them you want to go back to the borrower and reconfirm the information because, you don't want to just surprise them and, send out something that they did not expect. We always mention expectations. So you just clarify at some point if the borrower does want to buy it down more, you could explain to them the law doesn't allow it. The maximum the law is going to allow is a total, whatever, 5% up to a certain rate. Below that rate, it's not possible, and that's it.
Someone was asking in the chat how you came about the calculation. You just simply have to add up the fees. You just can't really read his text there. It's really small on the screen. He has a little bit of text there, but
what I can tell you is, I can explain it again. You get and you add the fees associated with the actual loan, the underwriting, processing, origination, the loan discount, which is a cost to buy down the rate. That's the one that's going to vary. And the mayor's fee. You add those fees up, subtract them from the loan amount, and then you get the fees and divide them by the adjusted loan amount to arrive at that calculation.
And I could simplify it a little more. If you're used to looking at the LE, it's all your box A fees, right? So it's all the costs of origination, which is all the fees in box A, right? It's all the fees that we have. It's not other people's fees. It's our fees as the lender, and that has to go into the calculation as well as what you're looking at here on the buy down option. So, all right, is that that's your last slide there?
Yes, sir. Yeah. I kept the best for last there, because I think this is so important, so important. I mean, if you master this, this is just gonna give so much more confidence to the MLO when they're presenting the product offerings. I mean, when you can just so wholeheartedly believe in the goodness of what you're offering, it makes it a lot easier. You did a thorough job and you honestly feel it's the best that the customer can get, is going to make it happen. They're going to feel that emanating from you. I think that isn't that what the book The Secret is about, right? Positive attracts positive, negative attracts negative. So,
Yeah. So, and then again, guys, remember we're putting these quotes, and doing that compliance will help as well, because the DSCR might be great options, but if the borrower can only get these rates, whereas you present the bank statement, which unlock these rates, and then you present the full doc, which may unlock these rates, you're going to present the borrower all the options, and all will stay in compliance. Because remember, DSCR is going to have the highest fees typically. So if you're running into what Jose just explained, that's where pricing it correctly with gathering all the information and saying, okay, I can give you a DSCR quote, but let's compare the bank statement and the full doc and the P&L, because you qualify for all of them, to show you, unfortunately with DSCR, we have to stay in this bracket, but with these other options, we can move around and have more flexibility. And again, the borrower will see it, right? That's the consultation part, right, Jose? You have to stay within the box here. We have to stay within the box here. We have to stay within the box here. But if you give all the boxes, now there's nowhere else they have to ask you to go. You've given them all the options. Now it's just it's not, are you going to buy a car, right? It's which color of car do you want? Which flavor of loan do you want? Which type of loan? Not, are you doing a loan with me? It's which option did you prefer, right? If we're only giving one option and we're only a bank that offers one option, right, then you can't propose that question, right? So you got to start with gathering the info, give them all the options, and then it's just a matter of picking one, right? You've led them all the way there. If you do the right job, right, Jose? It's all a matter of doing everything that you just went over.
Well, like you mentioned, then they have to pick one. But if they happen to pick one that shouldn't have been there in the beginning, then everything led up to that point, and then it's like a wrecking ball, just smashing it all down.
Exactly. So yeah, it's really key to get those 5 choices have to be correct, right? And we need to give them, I would say 5 minimum, right? I usually typically send 3 within each bracket, but then I'll send a couple different loan types as well. So you want to send some different LTVs, you want to send some different loan types, you want to give the options for sure, but they're all going to be valid.
Yep.
Yeah, valid. And also too, just to add to that, that makes sense, right? Don't just start throwing them quotes to throw them quotes, right? Make sure that they make sense. If your borrower says they don't have a large down payment, then don't send them 30% down quotes, right? Just to send them. So keep that in mind as well.
That makes so much sense, and it's I see it overlooked every now and then. That very important statement, right? So and I think that goes back to keep it relevant, right?
And someone was asking in the chat, we should add something to highlight the compliance. Well, that's the beauty of our system, is we do help you maintain the compliance, right? So a lot of times, sometimes you'll see a product hit and we have a valid product to offer, but we won't have any valid rates within that product. So you'll see a product show eligible and you'll see it look like it's going to show up, but then you can't actually pick any options. So we do try to protect you guys from that. But again, like Jose said, you still can make a mistake. We can't do all the math for you in every single case. And especially if you're quoting something very special and you're not using the CRM to do that compliance check for you, then it's all on you. So although we can help you, you guys must understand these concepts and embrace them, right? Because that's, again, what's going to present the right options. If they don't have the right options and they pick one, like Jose said, then you're starting all over from scratch, right?
It's so critical, especially on the non-QM files, is where it can become more of an issue. So just be aware of everything, just be aware and don't, stay in tune with the objective.
All right. Well, let's go ahead and wrap it up then. Appreciate everybody tuning in. We do this every Wednesday night at 7 p.m. Eastern for our sales training. And then, of course, we have our show 11 a.m. Eastern every weekday for the daily mortgage rates live. So thank you, Nick. Thank you, Jose. That was a great presentation. And hope to see everyone tomorrow at 11 a.m. Eastern time.
Thank you.
Take care, everyone.
Thanks all.